Hello everyone, this is Marshall Gittler for Claws and Horns, bringing you the outlook for the week beginning 17 July. The focus remains squarely on central banks and the growth versus inflation conundrum that they face. Bank of Canada Governor Polo summed up this dilemma when he discussed the reasoning behind the bank's decision to raise interest rates. He noted that there's stronger than expected growth in Canada, but said, meanwhile, inflation has continued to fluctuate in the bottom half of our target range. He noted, and this is the significant point, that this has prompted a lively debate, not just in Canada, but in many other countries, about the appropriate interest rate setting when economic growth is rapid, but inflation is low. I think this is the major debate that's going on right now among central bankers. Meanwhile, of course, the markets are trying to second-guess what the central bankers will do, which is pretty tough when even they don't know for sure. So the debate will go on among central bankers, and currencies will go up and down as investors listen to one side or another put their case forward. During the week, we have two major central bank meetings coming up. They're both on Thursday, the Bank of Japan, or BOJ, and the European Central Bank, or ECB. The Bank of Japan is widely, I'd say unanimously, expected to maintain its current stance. The BOJ has pledged to keep the stimulus flowing until inflation gets back to 2%. And so far, after 20 years of rates at or near zero, inflation is still only 0.4% year on year. In fact, the Nikkei newspaper reported that the policy board may actually lower its inflation forecast at the meeting. That would send the message that it'll maintain its accommodative stance basically for the foreseeable future. Now, while other central banks have started discussing the when and how of withdrawing their monetary stimulus, there hasn't even been a mention of this possibility in Japan. I expect that at the press conference, BOJ Governor Kuroda will continue to avoid even answering questions about whether they've discussed the issue. They're worried about even just talking about it would tend to reduce inflationary expectations and thereby reduce the impact of its stimulus so far. Of course, as other central banks talk about higher inflation and tightening policy, bond yields outside Japan have been moving higher. But in Japan, yields are capped by the BOJ's yield curve control policy, in which the banks pledge to keep the yield on 10-year Japanese government bonds at around zero. That monetary policy divergence between Japan and the rest of the world may provide a golden opportunity for the BOJ to realize its higher inflation target. As interest rates rise elsewhere but remain at record low levels in Japan, Japanese investors are likely to put more and more of their money abroad, while foreign investors are likely to use the yen as a funding currency. The resulting outflow of funds from Japan should weaken the yen and thereby push Japanese inflation higher. In fact, this may be one of the major reasons behind the BOJ's use of yield curve control as a policy tool. It's really a roundabout way to devalue the currency. I expect the yen will continue to weaken. The ECB also meets on Thursday. This is a more important meeting than the BOJ because the ECB is planning on changing policy eventually. The market currently expects the first rate hike to come sometime around March 2019. But before that, the big question, perhaps the biggest question facing global markets nowadays, is what the ECB plans to do with its 60 billion euro a month bond purchase program. It's currently due to run through December. Will they stop it then? Will they reduce it to 40 billion euros a month and extend it for some time? Or what? Everyone expects them to end it sooner or later. What they want to know is just how the ECB plans to do it. Now, one possibility is that ECB President Draghi announces at the press conference that they've started examining options and will make an announcement to the next meeting in September. That would probably be a powerful message to the markets, and the euro would be likely to strengthen as a result, in my view. On the other hand, it was just announced that Draghi is scheduled to address the Fed's annual Jackson Hole conference in late August. It'll be his first speech there in 3 years. The announcement rang some alarm bells because in his last speech at the meeting, Draghi dropped some hints that the ECB was about to embark on a QE program, a quantitative easing program, which indeed they did announce shortly thereafter at the September ECB meeting. Now, the Wall Street Journal reported that following Draghi's speech next month, the ECB, quote, is likely to signal at its September 7th policy meeting that the bond buying program will be gradually wound down next year, unquote. So the markets is going to be really waiting to hear what he has to say at this meeting. Not that the council might change policy, but to see whether they make some announcement that would signal a change in policy, such as asking for a study on possible options. There's likely to be a reaction in the market either way, but I think the possibility for an upside surprise to the euro is greater than that of a downside surprise. That is, if they do announce a timetable, or even just that they're going to start studying the question, then I think the euro is likely to gain. But if they don't make any such announcement, then people will simply think Draghi's saving it for Jackson Hole, and the disappointment may be somewhat muted. As for the indicators, this week, coincidentally, we get 3 sets of CPI figures, which play nicely into the discussion about central bank activity. New Zealand and the UK announced their CPI figures on Tuesday, while Canada announces its CPI on Friday. The second quarter New Zealand CPI is expected to rise a very small 0.2% quarter-on-quarter, down sharply from 1% in the previous quarter. That would only bring the year-on-year rate of change down a little bit to 1.9% from 2.2%. That's still right around the Reserve Bank of New Zealand's 2% target level and well within its target band, so it shouldn't set off alarm bells either way in New Zealand. However, it is yet another instance of inflation slowing down somewhere, which adds to the case against all of the central banks embarking on a global tightening cycle right now. The UK annual inflation rate is expected to stay the same, both on a headline basis and looking just at core inflation. This could indicate that inflation has peaked a year after the Brexit vote sent sterling crashing and pushed up prices of imported goods. If inflation is indeed peaking, then the hawks on the Monetary Policy Committee have less to worry about, and sterling could weaken as a result. The Canadian CPI is probably the least important of the 3 because the Bank of Canada has already said that it expects inflation to slow temporarily and that it's worried about inflation 18 to 24 months from now, not today. But in any case, the Canadian data is forecast to show slowing inflation as well. So this global phenomenon of slowing inflation is likely to bring the dilemma highlighted by the Bank of Canada into sharp relief during the week and pose perhaps the main focus of interest for central bankers and for traders. This is Marshall Gittler for Claws and Horns, bringing you the outlook for the week beginning the 17th of July. Good luck with your trading.